Okay, hi everybody, and thank you, Nicholas, for the invitation. Just to say first that this is a part of a project that I've started with Jakob Vestergaard, who's there. So anything that I'm saying wrong, blame him. It's a continuation of a project that we had together tracing the process and the fate of the European Commission's financial transactions tax. And in separate project that I have on the European repo markets. And somehow, when the Commission put the CMU on the table, these two projects came together in some interesting ways, and I want to explore that in this presentation. So, why is there a need to think about global banks or European banks that would be qualified as globally systemically important banks in the context of the capital markets union? If we think about the common narrative about CMU, the way that the Green Paper is presenting it, is that the CMU emerges as a consequence of the crisis and of the need for banks to be leveraged, and therefore a need to move intermediation of savings from the market, from the banks onto the market, having institutional investors and the famous SMEs meet each other through capital markets. However, what I want to do today is to tell you an alternative story. From the perspective of global banks, which is that we need to think about the Capital Markets Union project as as part of a longer historical process of European financial integration, and through a more sort of political economy approach to large European banking in Europe. And I will argue, my story is, or our story is basically that with the CMU we see now a return to pre-crisis political alliance in Europe between the European Commission, the European Central Bank, large European banks, and national member states. And that is an alliance that before the crisis has worked together in order to create or to support large banks' market activities. And I'll show you that a lot of it has to do with shadow banking. And that alliance with CMU is about rolling back the set of regulatory reforms that have been convened at global level through Basel III and at the European level. So, in some ways, continuing some of the stories that we heard this morning. So, just to, what am I talking about when I say there is a natural alliance? I didn't come up with this term. It was some political economists of finance, like Daniela Gabor and Nicolas Yapko. And they looked at the way that the European Commission and the European Central Bank were trying to energize the project of financial integration in Europe, and were also convinced that there is a narrative for the competitiveness of the European banking sector, particularly in relationship to the US financial institutions, was a story of promoting national champions, promoting European banks to become large enough with balance sheets large enough to be able to compete globally. And what we've seen with this alliance, and I don't have time to expand what that meant in general, but what we have seen is what Andy Haldane from Bank of England has called the collective migration in bank business models towards from this relationship or relational bank model that you mentioned earlier to a cross-border leveraged market-based banking. And we know that's the case because there are papers from the ECB, 2002 fascinating paper on global banks that highlights the increasing complexity and interconnectedness that European banks were creating, and highlights the potential risk or systemic implications of those measures. Of course, the ECB didn't propose to do anything because it didn't have a mandate for financial stability at the time, but there was clear awareness that the structural changes in European banking that were proceeding very quickly might have systemic implications. And what do these structural changes look like? If you look at this graph, we see that what the Financial Stability Board called global systemically important banks, a lot of them are headquartered in Europe, and a lot of them have balance sheets or had balance sheets in 2008 when the crisis came. Balance sheets that were higher in nominal volumes that, in some cases, than the GDP of the country where they were headquartered. So we're talking about global banks that were higher than, that had larger activity than the country that was responsible in some ways or assumed responsibility for potentially bailing them out. And if you read research from the IMF, this is not exactly the institution that you would expect to say stuff like this, but they do since 2010. They have a new sort of research angle on banks and interconnectedness, and they argue banks became as big as they did not only by expanding aggressively, but by aggressively doing tax arbitrage, regulatory arbitrage, and searching for meaning. And we know from the literature, from the political economy literature, that before 2008, that has meant a lot of market power and a lot of political influence, both at European and at national level. And we've seen since the crisis that it also meant that the way that the US crisis has moved to Europe has moved through Europe through the balance sheets of large European banks and some other medium European banks exposed to US shadow banking. From the Liikanen report, what this shift to market-based banking in Europe looks like, it looks like the blue stuff on both sides, on the assets and liability side of European banking sector, moving away from customer deposits, so taking deposits and lending through close immediate relationships that are information intensive, towards more market-based activities, and we see quite a significant share on both sides. So assets and liability, assets traded in markets and funded through markets. And I will argue that a lot of the blue areas that we have seen in the previous graph of what banks were doing and how they're funding it has to do with shadow banking. And there are some indications even from the European Commission that this might be the case. If you read their stuff on the reform of shadow banking, it's always being made very clear in the introduction to almost every document that I read that the reform of shadow banking is closely linked to bank structural reform in Europe. And I'll explain a little bit why that's the case. So, what do global banks and large European banks have to do with shadow banking? The typical argument that we hear when we talk about shadow banking in Europe is that, well, it doesn't matter that much because securitization volumes are much smaller in Europe than they are in the US. And indeed, this is one of the ways that the Commission is framing the need to re-energize securitizations. Money market funds, which we typically think of as shadow banking institutions, are also much less important. However, if we take the Financial Stability Board's definition of shadow banking, they make a difference between focusing on shadow institutions, so an institutions-based definition, and focusing on markets, right? So anybody or every institution is a shadow banking institution if it is involved in two markets, in securitization markets and in the repo market. And that is consistent with the definition of shadow banking that comes from Perry Merling, and then it has been taken over by the IMF, that calls shadow banking money market funding of capital market lending. Or if you want to juxtapose the FSB definition, money market would be wholesale funding markets, in particular the repo market, and capital market lending would be securitization, right? So another way of thinking about shadow banking is wholesale funding through repo markets, but also other markets of tradable assets created through securitization and other processes. If we take this definition of market-based or activities-based definition of shadow banking, we can see that the European shadow banking sector is quite significant, particularly on the wholesale funding market. And this is a graph from the ECB 2015 Financial Integration Report, and it shows that the secured segment of money markets, which is the repo market, where banks or other financial institutions lend to each other against collateral, it's grown very rapidly since 2003, and it's becoming much larger in size than the money market where banks trade with each other without collateral, the unsecured money market. So one of the systemic markets to shadow banking that we know experienced running the crisis, the repo market, and some people call the collapse of Lehman a run on repo. That is quite significant in Europe. And I've done some research on why this happened, and unlike the US repo market, the European repo market has been the result of a very close cooperation between public regulators and private European banks in order to use the repo market as an engine for financial market integration. That has to do a lot with what the repo is, right? The repo is a secure transaction. It's a loan of cash against collateral. And the idea in the ECB reports on the shadow banking, on repo markets and shadow banking, if you read them, or ECB reports on repo markets before 2000 The ECB was arguing that the European repo market could be an engine for financial integration because the more repos we have, the more demand for collateral we have, the more liquid the markets that collateral will be, and therefore the faster the financial integration process, which for ECB is very important because if you want to have a functioning transmission mechanism for monetary policy, you need markets to be integrated. Otherwise, theoretically, monetary policy doesn't work well. So the European repo market is quite large. In stock terms, this is from the European repo lobby for the European Repo Association. We see that European banks were, by 2008, funding almost half of their assets through, were funding through repo markets as much as they were funding through traditional deposit liabilities. Right, and if we are to take the repo lobby survey seriously, there is very little data on the repo market, but what we know from the repo lobby, then we see that the 20 largest European banks create 80% of or generate one counterparty to 80% of repo transactions, right? So 20% of 20 largest banks, 80% of repo transactions. Most of them would be also global systemically important banks. Another way of confirming that is to look at the membership of the governing body of the European Repo Council, the European Repo Committee, and you see out of the 17, I think I counted members on the board, half of them or more than half are global systemically important banks, and some of them are headquartered in the Eurozone. So for the purposes of the Capital Markets Union, and for thinking about the relationship between Capital Markets Union and shadow banking, it is important to bear in mind what this table tells us is that the European repo market is a market that is dominated and influenced by large European banks. So what does this mean? We now have research from economists and from financial economists that with new banks, with this reliance on markets, on both assets and liability side, we have new challenges. Financial fragility looks very different. I don't know if I have time to go through that. Global liquidity is very different. While we economists and economists, we tend to think of liquidity as something created by central bank in cooperation with the domestic banking sector. With the rise of global banks and their market-based activities, economists from the BIS argue, well, we have to think about global liquidity and global financial cycles. And it is these large global banks that move liquidity around across jurisdictions depending on very complex taxation and regulation arbitrages. Crises look very different. There is a lot of research being done on what crisis looks when banks depend on market funding and on liquidity, and a lot of it has to do with the way that the repo instrument is inherently fragile, and crisis management is very different as well. QE, I would argue, in the US, and the famous outright monetary transactions of the ECB have to do with the new challenges of stabilizing banks that are reliant on market liquidity. The traditional repo operations or long-term refinancing operations don't work anymore. We need a new policy. So, how is this all related to the Capital Markets Union? Well, one way of thinking about the Capital Markets Union is that it's trying to recycle or recreate or move shadow banking into market-based finance. Even Mark Carney said that, so we don't need to be a critical political economy scholar to recognize this phenomenon. One effort is to reinvigorate securitization, and we've heard from early presenters the process around that. But also, if you read very carefully the green paper of the European Commission, the CMU is also an opportunity to preserve the pre-crisis regulatory architecture of wholesale money markets, in particular the European repo market. Before crisis, the European repo market was governed by the private rules designed by European market participants. The European Commission took those rules seriously and created the collateral directive in 2002 and basically put into law what private market participants design in terms of risk management. And since 2008, as the FSB and regulators in general recognize the systemic problems of the systemic fragilities in repo markets and try to regulate them, what we see with the capital markets union plans is a return to the way that the European repo market participants think about what should happen to collateral and to repos. So if you read in the green paper, there is a notion of collateral fluidity, the idea that we have to allow collateral to flow uninhibited across borders in order for the markets infrastructure pillar for markets infrastructures to work well. And this, of course, connects to the early discussion on securitization, because some of the collateral will be the result of securitization processes. Why this is important, and touching on the issues that you raised about financial stability, is that the CMU plans are now organizing the European, or aiming to organize the European financial system around market liquidity. And this is where we can see a very clear link between the CMU and large European banks and all sorts of other banks. Because banks are market makers, or act as market makers in many of the asset markets, and partly because of the way that the repo market is structured, and therefore this has been the role of market makers will remain very important and will be at the core of the CMU plans. This is from the European Banking Federation's response to the CMU consultation, and Jakob said that you will not be able to read this, so I took out the interesting parts. In the second paragraph, there, the Commission, the ABF stresses that the Commission needs to place market liquidity and the importance of providing liquidity at the heart of CMU. Very important. And the second part, the adoption of the bank structural reforms would prevent universal banks from acting as market makers. If you study or if you read even what central banks are saying these days, you will know that one of the greatest theoretical challenges for central banks now is to define market liquidity and to understand it. It's very difficult to work out how would the market stay liquid in a crisis without central bank intervention. And this is through the CMU, we are moving towards a system where financial stability would increasingly rely on a notion or on a phenomena that we don't understand very well. The economics of market making is very difficult to explain in practice. So, what does this mean in conclusion? The 2008 crisis of European banking was a crisis of market banking. It wasn't retail banking that got the European financial system into problems. What we have seen with the crisis was two approaches that went hand in hand. On the one hand, both member states and the Commission said we need structural reforms, and with the Liikanen report and also the parallel regulatory process, the European Commission started thinking about what structural reform would look like, and particularly whether we need separation of banking activities. In parallel, we had a set of separate but connected reforms to try to contain the fragilities of market-based banking. The leverage ratio and the liquidity ratios in Basel III are basically trying to contain the fragilities of banks' reliance on financial markets, particularly on funding that can disappear very quickly in the crisis. If you take the view, if you look at the way that the CMU is organized around protecting the market-making role of large banks, and what I would argue is that the CMU makes one almost impossible politically. I doubt very much that there will be any bank separation rules that will come out of the European Commission, and it's also being used. The CMU is also being used to chip away at the set of regulations that have been put forward since 2008. You can look at the FSB regulations on the repo market, you can look at the Basel III liquidity and leverage ratios, and you can look at the FTP, anything that you want, anything that is in some way or another threatening banks' activities in markets will, I believe, be watered down quite significantly, because the Commission in the CMU basically believes that there is a trade-off between growth and regulation, and it states that trade-off. Okay, I'll finish here. I'll just leave you with this quote on Basel III liquidity ratio from someone working for BNP Paribas, that says whatever bankers are saying how biting the liquidity ratios will be after 2000, the regulations in 2012 look like there has been a fairly massive softening of that approach. So this quote for me is part of what we see a sort of pushback from large European banks through the political processes of the CMU and others in order to water down inflation.
Thank you very much. All right, shall we take some questions? Yes, please.
Hi, thank you very much. I was wondering, you suggest that bank structural reform will not happen, but actually there is a banking structural reform proposal currently going through the legislature in the EU, and it's also we've already implemented bank structural reform in the UK, and I understand the current approach of Council is to permit the UK to maintain that. How do you see that sitting in light of what you're saying here? And are you suggesting perhaps the UK is not aligned with CMU thinking in this way, or?
We want to take a few questions and then, yeah. Any other questions? Yes?
So, given the second question, you pointed to the retail market and this securitisation market as separate separate case of shadow banking. Are there cases of combining the two together to form a single chain of shadow banking?
Any other questions? Oh, maybe we take these questions and see.
Can I ask a question on from the first speaker?
Yeah.
So maybe we can have a conversation. Could you comment, from the way that I've been following the CMU, there is an argument, at least from Juncker, that you cannot have a capital markets union without having the kind of legal institutional structures in place that we now have with the banking union. There is this idea that ESMA will become a supranational regulator of integrated capital markets, instead of leaving it to national regulatory authorities. What are your views on it? Is this something that can work, and what would require for this, if politically is possible with the UK to move stuff supranational?
Yeah, well, it's a very good question. I think definitely within the banking union there is an understanding that this would grow wider to include capital markets and wholesale banking structures, at least. And then, but the problem is that the banking union is only the Eurozone plus participating member states who sign up to it. And I think what Juncker wanted to do was he wanted to have the capital market union as a logical next step. But then he had the problem with Britain wanting to renegotiate the treaty and all these political issues. So he then said, well, let's do capital market union, but make it for the whole EU. And that way it will require Britain to have a lot more skin in the game to want to stay in the EU economically, if they could feel that they were part of the formulation and the development of the capital market union for the whole EU. But the regulatory objectives, I think, of the UK policymakers will be different from the policy objectives of the banking union leadership, because I think the focus clearly in the Green Paper is to have more of a free flow of trade and capital flows cross-border within the internal market. There's a lot of good things about that. It reflects on the notion of the internal market that should be developed further. And then there's the traditional, we have to be more like the US. I mean, we saw this before the crisis with the Gio-Benini report on the clearing and settlement. You know, the US has got one clearing and settlement silo, so Europe has got 28, so we need to have one. So we should move in that direction, because the US is that way. So this is, the capital markets union seems to have taken on the mentality of the McCreevy era, the pre-crisis era thinking, that we need to develop a robust market-based securities market, both retail and wholesale, And what you pointed out is the banks would be very much a big player in that, and that raises the systemic stability issue, which the Green Paper doesn't really address, and doesn't really have a framework for looking at the potential risks that can arise because of financial stability. And I think your presentation really highlights that it's almost like it's a big conspiracy on the part of the banks to sort of to do some of their risk taking through the capital market union model to evade some of the stricter requirements that they have under CRD in the capital requirements regime. I think that generally what's happened is it's institutionally it's incoherent now. You've got the banking union with the ECB supervisor, you've got the resolution framework in place, and now they have a capital markets union that has to be linked institutionally in some way with what's going on in the banking union. It doesn't have to be the same countries in the banking union, but it has to have some institutional interface, and they just don't have that. As clear as at least with the banking union, you have the EBA, the European Banking Authority, and they draft technical standards that they hand down to the ECB, and the ECB then implements it. But with ISMA wouldn't be in a position to tell the EBA, the ECB to do anything. And so you have, and then it raises the question, should we have a stronger regulator for capital markets in Europe? And I just don't think that the current treaty permits that, the Moroni limitations, and that you'd have to change the treaty to do that. To make this more institutionally coherent. So there's one view that says you don't need to have an EU regulator, this will just be a great free market, will be stable. It's not systemically significant what all these people are doing, it's just retail finance and some wholesale on the side. So don't worry, there's no need to have a regulator at the EU level, or to have any prudential oversight even at member state level, or probably. We can keep this away from the banking regulators, that's something but it's really not. It's part of what the banks are doing. So that's what your presentation clearly shows, that there is a systemic element here that's not been addressed in the Green Paper. And my question is, well, I hope they address it in the follow-up paper. or if they don't, then there's some other hidden agenda that the public has not been told about. So.
Okay, so maybe I can.
Yeah.
I think it's a matter for debate. Thank you for your question. I think it's a matter of debate. My understanding of what is happening at the moment is that there is an ongoing discussion inside the European Parliament, for example, on separation and structural reform, and in general, the new Commission has shifted the narrative in Europe from stability to growth, and the European Parliament is not going to oppose that growth agenda. And I think with the CMU, banks can make a very clear and persuasive argument politically that they will be doing that. So I doubt it. I doubt that this is the basis for my hypothesis. Whether this will come true or not, I don't know. I've been following closely what the European Parliament is doing on reforming the repo market. We know that there is at global level, the FSB is sort of negotiating, reforming, or introducing certain counter-cyclical measures in the repo market. That discussion has been watered down to something that will probably cover around 10% of the repo universe, so not very much. At European level, the ECB is concerned, but their response is reporting and transparency. If we report them and we know them and we can trace where collateral is going, then everything will be fine. And then when this reporting and transparency directive went from the Commission to the European Parliament said, well, hang on, it's not only enough to know who's trading with whom and what collateral is moving between the two parties, but we also need to have counter-cyclical measures because this is a systemic market. And they put the FSB very watered-down proposals inside the reporting and transparency directive, and it's been kicked out 2 weeks ago through the work of there was a dialogue between the Council, the Commission, and the European Parliament, and it's gone. So the way that I view that every single thing that is happening in relationship to this and banks is to suggest that there won't be any separation. On the UK, I don't know enough. I understand that the Vickers recommendations are not actually yet in practice, so I don't know what will come out of it. But from what how you elaborated
It's-
the interest of the UK,
Yeah.
I would very much doubt that the UK now will push for bank separation.
Well, we just yesterday, Sir John gave his evidence before the House of Lords Economic Affairs Committee and said that he stuck with his proposal very strongly in saying that it will actually save the banking industry money if they do his structural reform. And then there's Sir David Walker, who has written and saying that we need to get rid of it. Basically, it's too much of a cost for the big banks, and the banks are not able to lend us money. The traditional bank pushback argument. So now, but it is in the Banking Act of 2013. But the implementing measures have to be implemented over the next 2 or 3 years. Secondary legislation is being written. But basically, the retail bank requirement is law, but the phase-in is over a period of time. So they'll probably do that in the UK, but it's a very interesting question because what will happen to the rest of Europe? And my understanding with the structural reform issue is you've got a draft regulation now that the Commission's proposed. And now the draft regulation, though, allows countries to have equivalent regimes, Article 20 in the draft regulation. So if you don't want to do what the Commission proposes, you can do your own structural regulation. And so Germany and France have beat everyone to it by adopting their own legal framework that basically allows the bank, the retail bank, to do proprietary trading, but defining proprietary trading very narrowly. And then stuff that you would normally think was proprietary trading, like market making, things like that, it's debatable whether it is, that's shifted off into an investment bank subsidiary for secondary trading. And so you basically preserve the universal banking model in Germany and France. So the structural reform has been watered down, at least in Germany and France, in order to protect the big French banks and Deutsche Bank and Commerzbank. And so now the UK has got a little bit more of, a stricter regime that doesn't have all the loopholes. Because you do have, I mean, there are some loopholes that could be developed through secondary legislation, but the problem with the Commission proposal is no other member state other than Belgium, France, Germany, and the UK have proposed structural reform legislation. And so everyone else has to do what the Commission proposal says. And the Commission proposal basically bans proprietary trading in the banking group. But it defines it very narrowly. So that's a big problem for, if you're not in those 4 countries that have basically allowed the proprietary trading. If you're Italy, for instance, or Spain, you're now subjected to this proposal that bans proprietary trading. And now because of this, it sounds really like a big mess, doesn't it? It is. And that's why the European Council website has got, if you go, I wrote an article on this, and so I probably know too much that's of any significance. But basically it's held up now in the Parliament and in Council because there's a big backlash from Italy and Spain and other countries that rely heavily on the universal banking model. And they're saying, look, you're going to kill our ability to have risk diversification, do all the things that we think universal banking model is good for, in order to have this, to block out proprietary trading, and that you've let Germany and France adopt their own secondary legislation, and their own legislation to let them get around the Commission requirement. And if they think it won't be a level playing field. What you'll have in Europe, you'll have all these different structural reforms. And it will not, and so the question is, maybe that's okay. Maybe we should just accept that each member state should do it a bit differently. Britain has got their own focus on retail bank separation. Let them do that. The French and the Germans want to preserve Deutsche Bank's ability to do proprietary trading. So let them do that. And then let everyone find their own equilibrium in their national markets, and don't let the European Commission dictate some prescriptive framework from Brussels. Maybe that's a better, and that's why the structural reform law will probably break down. I think, but it's proposed, but it's not yet approved, and there is a lot of political opposition against it, as you were saying. So.
Yes, maybe I'll go to the second question. If you read, I didn't mean to suggest that there are 2 different activities in that way. I mean, they are interlinked through the definition of money market funding or capital market lending. And if you read Zoltán Pošár, who is one of the authorities on shadow banking, has these really big, complicated maps that look at the chain or the securitization chain, and at the end of the chain, it's always a repo market. So at some point, securitization activities will be funded in the repo market. Not so much in Europe. So the US and Europe look institutionally very different, and that's why US shadow banking is different from European shadow banking, because a lot of shadow banking in Europe is done by large banks. And the CMU is a form of protecting those activities from regulation, from structural reform. And yes, I don't know all the details that you created. I hear that. I don't know all the details, but it's the same story and the same intuition there. And it's quite. If you want to believe in conspiracy theories, as you pointed out, the 2002 paper of the ECB that I was mentioning, right, where it said we are getting concerned about the activities of large banks. The three banking sector that the ECB mentioned were France, Germany, and UK. There you go.
Are there any other questions? Yes.
So, for Professor, so why do you think this functional approach to regulating this systemic risk banks haven't been adopted? It seems a very good sensible approach.
Well, it's a good question. You know, there are all these different models of regulation, functional approach or institutional approach, and so markets have evolved historically with different institutional structures. Also, the regulation of banks, the focus in the 1930s and 40s was more on protecting depositors and not really protecting. There was not really this notion that there was systemic risk. I mean, there wasn't a literature on that back in the 30s, but there was a problem of banks failing and depositors losing their money, and they're in the stock market crashing and things like that. And so the focus of bank regulation in the U.S. really until the 1980s, until Basel I was adopted, was you had prudential bank regulation and capital requirements to protect retail depositors. Because if a bank failed, the innocent customer would lose their savings. And so now you wouldn't care about the wholesale depositor. They would be able to fend for their own interest, right? They would be able to, before they deposit the money in the bank, they would read the bank's annual report, maybe make an assessment of the risk. We know that they don't even read, they don't even do assessments in securitization markets, so they're not going to, they probably wouldn't do assessments of bank risk taking either. But the notion, but see, functional regulation would say the intermediation function of the bank, borrowing short from any depositor and lending long, any institution that does that would be defined as a bank or a credit institution because they're borrowing short and they're lending long. It doesn't matter if they're doing it from retail depositors or not. See, in Europe, they say it's a focus. They say, well, it's retail, it's public that we're worried about. We don't really care about the big banks or the banks that told us that don't worry about it. And so we don't protect them for prudential regulation. The CRD doesn't require them to hold capital. There's some investment service firms in the CRD that do have to hold capital. So I agree, I think there should be more of a functional approach to regulation in Europe, especially when the focus is macro-prudential. So I think one reason why functional regulation didn't work in the old days was because it was a micro-prudential regime. The regulator would say, well, we're concerned about certain banks that have depositors, and so they have to hold capital. And then we're going to regulate their concentration risk and things like that. But if you had an institution that took deposits from high net worth, wealthy investors, the regulator said, we're not really worried about that. We're not worried about protecting these people because they're not a concern of the public. They should be able to protect themselves. But we see that was the old micro-prudential philosophy. But in a world where the risks were all interlinked, you see, where the sophisticated asset managers, what they're doing has systemic implications for the small person, for the retail depositor, then we need to have a more of a functional approach to regulation to take into account macro-prudential risk. That's what I would argue. So because, you see, the old regime was micro-prudential. You didn't need to have functional regulation in micro-prudential regime. You could have had it, but the marginal benefit of it wasn't so great. But in a macro-prudential regime, you need to have it. So, yes.
All right.
The gentleman has a question.
Questions? Yeah, go ahead.
If we have time, the conversation about political economy, I just was wondering about where you see the politics, where is the politics driving this? Where is the shift? You kind of a back to the future argument, or back to the 1990s, and is it, when I look at the composition, political composition of the major powers in Europe, there's no big earth-shaking changes there. The same government here we've had the last, the same party leading the government in Germany hasn't shifted, and so we're, and there's been changes in the commission, of course, but they're appointed by those member state governments to a significant extent. So where is this political shift coming from?
Well, I mean, if I just think about the Commission, right, so the work that I was citing on the political economy of the Commission and its relationship to finance, the argument is that before 2008, the Commission wanted, I mean, the purpose of a supranational institution is to get more power moved at the supranational level, and for the Commission, the only way that they could think of doing it is to, what Nicolas Jacob called, playing the market, right? So selling the market in different ways to different constituencies, sometimes to say only a pooling of sovereignty at the supranational level will protect you against American capitalism or globalization, sometimes selling in the market to constituencies that really wanted more market processes. And it was in that respect, for the Commission, it was easy to create alliances with both member state political parties and governments and with the financial interests. And in 2008, that process sort of broke down, and we had the Commission. I think what Lord Hill said at the public hearing on CMU, he said before, after 2008, we did things to European finance. Now we're doing things with European finance again. And that, for me, captures the ethos of the new Commission. It's the only way to move European integration forward in this story is to work with finance to achieve financial integration. They don't have another solution. I think if you reflect on the financial transactions tax, the Commission framed it as a way of pulling fiscal sovereignty at the European level, taxing finance, which was quite sexy after the crisis, right? Because we paid for the cost, and it didn't work. The European member states at the end, with some help from this city, refused to accept that taxing finance and having the money go into the European budget would be a way of moving the European process forward. So they're back to the old strategy, because I don't think that there is the Commission can imagine a new strategy where it doesn't involve doing the same as before.
All right, I feel we have to stop here. I think all that is left to say is to thank our speakers for a very interesting discussion, and I think there's coffee, so I will see you out there. Thank you very much.